Ready?
Yep.
Well, good evening, ladies and gentlemen. My name is Adrian Day. I am privileged and honored to have been asked by Rich Checkan, who I'll introduce in a second, to be a co-host on these on the move series of webinars. It's a great privilege, but also, frankly, a great pleasure, because I've known Rich for, oh gosh, what, 15 years maybe?
I think longer than that.
Longer than that. Well, time flies when you're having fun. So Rich is the president and COO of Asset Strategies International, ASI, which is a gold bullion, gold and silver bullion and currency firm based in Rockville, Maryland, near Washington. As I mentioned, I've known Rich, well, what, maybe 20 years, but before that I knew your uncle. Well, I know your uncle, I should say, Michael Checkan, who founded the firm. And I believe this is your 40th year, is that right?
It is. 1982, they formed this, Glenn and Michael.
Well, I really appreciate you inviting me to be your co-host, Rich. So over to you.
Absolutely, our pleasure to have you. And folks, I don't think I need to do this next part, was introduce Adrian Day, because I think everybody knows Adrian Day for as long as I've known him. But what can I say? He is by far one of our go-to experts when it comes to world or global and resource asset management. One of his 3 books I have here right now. If you haven't read this, I'll tell you, you need to. Investing in resources, how to profit from outsized potential and avoid the risks. If you want to know anything about resource stocks, that's probably the #1 book you want to go read. I read it, enjoyed it, and liked it so much I went back and read it again. Adrian Day is London born, as you can tell by his accent. He went to the London School of Economics. I believe I said that right, Adrian, as opposed to economics. And he's been a financial newsletter as long as I've known him. He's been a fantastic money manager. He manages the Europac Gold Fund, which I know we can't talk about performance, but look it up. I think you'll be impressed with the results that he's had over the years. Again, our go-to guy, and an incredible mind filled with knowledge and experience over the years. So Adrian, I am just as honored to have you as my co-host, and looking forward to having a lot of fun going forward.
Thank you.
And I'm also very excited to welcome our special guest tonight. I've known Tom Dyson a long time. Last time I've seen him face to face, I think we shared a cup of coffee at Starbucks in Delray Beach, and that was a long time ago. But Tom is a very interesting young man. He grew up in Chiswick, London, which is where he's coming to us, or is it Chiswick, London, or Chiswick, England?
Both, actually.
Okay, so Chiswick, London, England, and that's where he's speaking to us from here tonight. He is the investment director for Bonner Private Research. I think we all know Bill Bonner and what he's done over the years and how many people he's influenced. He's partnered with Dan Denning, who looks at the macro or the big picture. And Tom is, as he says, where the rubber meets the road. He's the investment guy that picks out the investment choices for their portfolio, and really looking forward to tapping into his mind, because he is very much a contrarian investor and a very successful one over the years. I think you made your first trade at 12 and you only made like 350% or something like that. So obviously he's gotten better over the years, but wonderful gentleman who's got some great theories on Dow, gold, energy, container ships, you name it. And we get to tap into his mind tonight. So welcome, Tom.
Thank you very much, Rich.
Glad to have you. Thanks for saying yes. I want to jump right into it, because a lot of people want to hear what you guys have to say. The first question I've got for you is, what are your thoughts on the Fed's wrecking ball, and how do you think it's going to have an impact on the markets going forward?
We're talking about the dollar here, and I think the bottom line is we're at war at the moment. There's a war. It's not just Ukraine against Russia or Russia invading Ukraine. It's a much broader war than that, and it's a political strategy to use the dollar to inflict as a weapon in this war, and it's worked very well in the past. The dollar is, of course, the world's funding currency. So by pushing up its value, it it puts a lot of pressure, economic pressure on basically every other country globally. I've been thinking about this a lot. There's a couple of issues with this. I mean, they have to do it because you can imagine politically how bad it would look if oil went to 150 because they were running the printing presses and devaluing the dollar. It would be playing right into Russia's hands. It'd be very effective for them. So, but there's a couple of issues, and it's a little bit like a drug. So it's like a drug that has side effects. And what I mean by that is by running the dollar higher, it's inflicting pain at home. It's putting a lot of pressure on highly leveraged companies, on the highly leveraged economy. And so there's a question of at what point do the side effects become worse than the benefits that the drug is supposed to be curing? That's the first issue. And then the second issue is that a tolerance is developing. And what I mean by this is the countries or the effects that this drug is supposed to be having on the rest of the world is getting weaker. And that is because Russia, China, India, they're starting to figure out ways of going around the dollar system. So by swinging the wrecking ball, it's not as effective. There's a tolerance has built up. And I think the big mistake of this is that it's going to push other nations to seek other ways of doing business outside the dollar, and ultimately it's going to be a failed strategy. But that's what I think is going on.
Don't you think that's already happening right now? I mean, think about it. People or countries that have zero qualms with the US whatsoever are on their good list, if you will, are thinking twice now. They're like, what will I do, intended or otherwise, in the future that all of a sudden puts me on the bad list? And now I'm a victim of dollar weaponization.
Yeah, I think it's just very bad policy to use the dollar as a weapon. Ultimately, it's weak, and it'll undermine the very value of having the world's reserve currency. It has done already. Yeah, this is a process. This is a trend in process.
I think it's super strong, and it's like the Maginot Line until somebody finds a way around it.
Yeah. Well, in many ways, you mentioned at what point do the side effects become greater than the medicine of the disease you're trying to cure, and you know, in many ways, policies can work when they're moderate because people who are negatively affected will accept it or tolerate it, or it's not worth fighting back. But if you push that policy too far for too long, then the people who have pain inflicted start to find ways around it, as you just mentioned with the dollar. And you know, it's obviously also true with you know, inflation. You mentioned oil, but of course a stronger dollar helps export inflation generally. So if the dollar, so at the moment the US is making inflation perhaps less than it otherwise would be by having a strong dollar. But if the dollar drops, you know, 10 or 20%, which, you know, is not an extreme when you look at what the dollar's done over the last couple of years, that would, other things being equal, start to push up consumer prices in this country. So I think part of the problem is that we sort of push policies too far. And just to conclude on that point, if I may, Rich made the excellent point that, you know, even countries that are friendly to the US are beginning to wonder what they might do in the future to be on the bad list. I mean, you know, England was on the bad list in 1956, that's a long time ago. But Switzerland, of all places, was on the bad list, you know, for bank secrecy, not so many years ago. And so a lot of what we'll think of as friendly countries, respectable countries, can get on the bad list.
Yeah, it's these unintended consequences. I got to tell you, I'm a little bit of a weird guy. I think Adrian knows this. My two biggest influences growing up, I told you this in Vegas here recently, was Monty Python's Flying Circus and Bugs Bunny. So that should explain a hell of a lot about me.
Explains a lot.
But one of the things I find a lot of fun right now is watching pharmaceutical commercials on TV. And this is what I'm thinking about when you're talking about the drug and the consequences, and at what point is the remedy worse than the actual affliction. I love it when you get on there and they say, okay, you have a little itch on your cheek, you take this medicine and everything will be fine. And then they give the long list of side effects, which include death has happened. I think that's what we're talking about here with the dollar. This is potentially death has happened for the reserve currency of the world. And let's face it, there's no entitlement as the Fed or the world's reserve currency. Other countries have held that baton and they have passed it off over time. And I hate to think that we're nearing that point, but it sure looks like we are. And for people out there listening, the thing that changes is your lifestyle changes drastically. I mean, we finance this lifestyle off the world's, debt, basically.
How do you see that, Tom? How do you see the dollar playing out?
I think it goes up and then it goes down. I think I mean that everything made a lot more sense to me as soon as I started looking at the markets through the filter of warfare. And until then, it didn't really make sense why the Fed would be intentionally driving a recession, or why Washington decided to put these snap sanctions on that really seemed to be that they did it without thinking about it very deeply, and definitely without consulting the bankers. But so I think that they will continue running the wrecking ball, and I mean. I think the dollar is going to make new highs in the dollar index. It's going to have a great confidence in that, but I suspect that there's new highs coming, and then something will break, and then the pain will be more than the benefit, and that's when they'll have to turn around and start pursuing a weaker dollar.
Can I maybe change the subject a little bit, ask you another question, Tom? I just read your generational regime change. That was just an excellent piece. And hopefully you'll let subscribers know or listeners know where they can get hold of it, where you talked about fundamental shifts in business cycles, in markets, in psychology and valuation, just because of a change in central bank policy. I thought it was an excellent piece, but one thing that I wanted to question you on is where you said it's insane to believe the Fed will pivot on interest rates. Now, I was certainly one of those who, for the last year, have argued against many of my friends who expected an immediate pivot. And largely because this is not 2018 or 2015 or 2013. We actually have a dragon to slay. We have inflation now. So I argued about that. But the question I have for you would be, I guess, a question of timing. Do you think the Fed, I don't know whether your comment about insane was based on the market reaction to Jerome Powell's seemingly dovish press conference comments, or are you talking about something more fundamental and more long-term? Do you think the Fed, this Fed, under Jerome Powell, does it have the fortitude to raise rates sufficiently to bring inflation down close to their target, even at the cost of a serious recession? That's the question for you.
It's an excellent question. Well, I've just got a couple of sort of observations that I might share, and hopefully they answer the question. One is, I've always thought the Fed, despite what you read and what image they give off, are followers rather than leaders. And they tend to react to the markets. And so in order to have a Fed pivot, I imagine first you have to have a really weak market that then the Fed has to quickly run behind to try and raise asset prices again. So I think that's sort of it's putting the cart before the horse. The markets are the horse and the Fed follows. The other thing is, if you'd asked me 2 years ago if the Fed would ever be raising interest rates again, I would have said no. I don't think they can. I don't think the federal government, with its massive debt load, can afford to pay higher interest rates on its debt. And I'll be honest, I'm surprised that interest rates have lifted off at all, and I didn't expect it. And now that they have, I watch all Jerome Powell's press conferences, and I read all the comments that they put in the press, and Powell's even been invoking Volcker. So I just think if they were to pivot now without some kind of serious breakage in the economy or the markets, the Fed's reputation will be damaged irreparably, given that it's already not that great.
I was going to say even more than it already is.
Exactly. So I think like there will be no coming back from that ever again. And so I am in the camp that, and given the fact that we're at war, I think the Fed is pursuing a rather dogmatic approach to interest rate policy that is now, for the first time in certainly since Alan Greenspan's time, they are not they're not extremely sensitive to the market as they normally are. And so, and I just want to add one more thing. I think people give the Fed way too much credit for being intelligent and knowledgeable and wise than they actually are. I'm not sure that they understand that by raising interest rates as aggressively as they are, it will break the markets and the economy. I'm not sure they even understand that.
It looks like you're ready to say something.
No, I mean, I'm not even sure that Jerome Powell and Yellen and maybe even Bernanke really appreciate the role that the Fed itself played in creating inflation by their excess money creation. They got away with it after 2009 for reasons we know about, paying interest on excess reserves and the banks just not lending money out into the real economy and keeping it on deposit. They got away with QE after 2009, and I suspect that they don't see the direct connection between excess money creation and inflation. I agree with you, Tom, what you're saying for the short term. But you mentioned they don't realize something's going to break. And when it breaks, I have a feeling that even if they don't pivot, which might, as you say, damage their reputation, their remaining credibility beyond all repair, but we'll see a meaningful pause, I can't help thinking.
Yeah, there's a definite difference between a pause and a pivot. For me, a pivot is actively cutting rates and reinflating reserves and printing money, whereas a pause is to just stop. And then we haven't talked about QT either, which I actually think is probably a bigger deal than interest
Absolutely.
rates. So yeah, but I mean, to me, again, it comes back to the dollar. I think they're going to have to debase the dollar in the end. That's the end game. Is the losses have to show up somewhere, and I think they will manage it so that the losses show up in the currency and not in the bonds or in the asset prices.
Excellent.
Yeah, I mean, there's so
No, I know before you go, can I just
Yeah,
address something you said, Darren? Can you pull up that graph that I gave you on the Fed hawkish
yes,
on the balance sheet?
absolutely.
You know, Tom mentioned the balance sheet. You know, they've been talking about QT for what, 9 months, but they've had a timetable for the last few months. And we're 2.5 months into when they said they were starting QT. We should be down 119 billion and we're down 36 billion. We're down about a third of what we should be by now on their own timetable. If they are going to start next month, basically next week, if they're going to start reducing the balance sheet by 95 billion a month, I agree with you completely. That is for the economy more than the market. Interest rates perhaps are more important for the market, but QT is far more important for the economy. If they start to withdraw 95 billion a month from the balance sheet, from the economy, essentially QE was adding liquidity to the economy, so QT is withdrawing liquidity from the economy, and that's going to have a very significant impact on the economy. But can you put that thing up, Rich?
It should be up.
Oh, I don't see it. You need to hit share screen.
I already did, and I think the viewers can see it.
Oh, okay. Well, if the viewers can see it, this basically shows where the Fed's balance sheet is right now. That's essentially 9 trillion, all but 9 trillion. If you go on this most aggressive policy that the Fed, any Fed spokesman is talking about, of 95 billion a month for the next year, we will end the next year just a tad under 8 trillion. That is not hawkish. That is more than twice where the balance sheet was just 2 years ago, and is 10 times where the balance sheet was in 2009. The economy hasn't grown tenfold in the last 14 years, and it most certainly has not doubled since 2020. So, you know, even on this aggressive policy, so-called aggressive policy, they are still, in my view, they are still not doing enough to, as it were, restore normality. And the problem, of course, is that they kept everything too easy for too long. There are those who will disagree with me about what they did in 2009, whether they should have done it or what, and what they did in March of 2021, and whether it was too much, and so on and so forth. But I don't think many people disagree that they just stayed easy for too long, which makes their job today much more difficult.
Okay, and I apologize. Somebody's saying that they don't see the screen. I'm going to try one more time.
Well, you can see on this. I mean, I don't want to repeat everything, but this is the Fed balance sheet. No, go back. Go back.
I'm trying to.
Okay, virtually 9 trillion. And if they do what they say they're going to do, will be just a tad under 8 trillion. So in the long scheme of things, that's not particularly hawkish.
Gotcha. And the other thing I just want to draw people's attention to, I'm assuming you can see it now since Adrian can see it, that part up at the top right, it's something we talked about in Vegas about a month or so ago. You know, how long have we been drawing down assets from the balance sheet? It doesn't look like it's coming down. It was actually growing, right?
Until just the last month. We're now down in the last 6 weeks. But you know, if you go back to the beginning of June, they've increased the balance sheet more weeks and they've reduced the balance sheet.
Okay.
And at the moment, it's only running off. Of course, they're just letting treasury bills and bonds mature and run off and not replacing them. Once they actually start selling, then that raises a question, you know, to whom? Who's going to buy? Who's going to buy at that point?
Yeah. Well, and here's the thing: the Fed owns how much of that debt, right? They're basically they're financing themselves, if that could even be done. I still have a problem, you know, computing that in my head. But they just let the assets run off the balance sheet. They forgive themselves the debt. is basically what it seems like is going to happen, and what impact does that have on the economy going forward? Somebody's going to pay the bill. It's like the student loan debt that was just forgiven. 20 million people are going to completely have their debt forgiven because it's $10,000 or less, or whatever the case might be. That's a lot of money. Nothing gets forgiven without it being paid somewhere else. Somebody has to pay that, right? So I don't know how they get out of this. And, I do think that this is what I was going to mention earlier in your comments, Adrian. I do think they know what they did. That's maybe I'm a little too pessimistic. I don't know, but I think they know exactly what they did. They just don't want to admit it in public. That they can't be that dumb where they don't know that increasing the money supply has an impact on inflation. They cannot know that and be in the position they're in.
Well, they're not monetarists and they're not Austrians.
Well, I think my 15-year-old son understands this. I don't understand why they don't. So I believe that they know what they did, and they just don't want to admit it. This is a political animal, and their job, their third mandate, is basically to, keep everybody feeling wonderful. It's that quote from Ben Bernanke in 2012 or something, where he said, "Listen, it's not about being wealthy. It's about having everybody feel that they're wealthy." All right. If their 401k is ballooning, if their home value is ballooning, everybody feels better, and they go out and they spend money, and that's what the companies need. They get the velocity of the money out there, and the companies can grow and hire and do all those wonderful things. But it has nothing to do with actually being wealthy. I think Bill's made the point here a few times here recently in his missives that the actual middle class is going south right now. I mean, we've got inflation of 0, or in other words, 8.5%, down from 9.1. And that is still way above wage growth. So inflation went down, but people are far worse off than they were. This is not a good scenario.
Right.
Anybody want to add to that? Paint a pretty grim picture. I mean,
I think the true mandate of the Fed is to make sure the Treasury looks solvent. Isn't that ultimately Fed's job?
And it's hard to do that when you've got to cover the bills written by people that have no fiscal responsibility whatsoever.
Well, you made a good point, if I may, and I don't want to sort of get off topic, but you said with student debt, someone's got to pay. I think all these policies, to me, one of the most damaging things that these policies have is what I'll call the social damage. You think of a student that borrowed money and worked hard and saved in order to pay the debt back. People who took a second job, people who forewent a holiday so that they could pay back the debt and pay it off quickly. They must be asking themselves, am I the sucker? And, it's the same with QE. When you think about QE and low interest rates, who are you punishing? You're punishing the people that did the right thing all their lives, the people that did not get into debt, the people that, bought things when they could afford them, the people who saved money. They are the ones who are being seriously affected more than the people who got into debt and don't have any savings. And so we're damaging the people, we're hurting the people that did the right thing. And that, I think, is very, very serious.
No question. Just if I could divert back to you, Tom, you have this concept of inflation volatility. You want to touch on that a little bit? Let us know what your thoughts are there and the impact that'll have on us.
Yeah, it's the insight that inflation is not going to be a linear phenomenon. I think for me, I'm always going through my own personal learning curve, and I always sort of thought that when inflation came, it would build up a head of steam and just keep going, sort of like a launch. But now I think it's going to be much trickier than that. I think that's too easy, because then then it's actually easier to invest for inflation than it is to invest for inflation that comes and goes. And it's actually quite difficult. So my thought is that inflation will come and then it will disappear again. Just when everyone thinks the all clear is, then it'll come back with a vengeance and catch everyone on the wrong foot again. And so that's sort of how I've prepared mentally to deal with this, is to not, and again, you mentioned I'm a contrarian. My natural approach to markets always is to do what nobody's talking about, to expect the unexpected. And so when everyone is talking about inflation, and there was a time about a month ago where I looked at the newsstand here in London, and inflation was on the front page of every single newspaper talking about the cost of living crisis.
We got tired of writing about it, but we had to, because that's what everybody wanted to talk about.
In my experience, that always is the only sure thing. The only thing that I've learned about this game of speculation is that when something's covering the front pages of the tabloid newspapers, which, sorry, my camera's unfocusing like that.
Your voice is clear, and that's the important part. So.
When the tabloid newspapers, which are the most populist form of press, are carrying a certain message, it's already been priced into the markets. It has to be. So I'm not sure if I'm giving you a good explanation of how I came to this, but I think my model is that inflation is going to come in pulses, and then retract and keep everyone losing money, basically make it very difficult for investors to invest profitably in this. And I think it comes down to another sort of model that I've been using a lot, the inflate or die model. And that is, they've basically inflated a massive bubble, a massive speculative bubble. And the only way that there is any sort of stability in this bubble is continued growth in debt and inflation, and not just a level, but it has to keep growing. But now they're definitely not growing it. They're tightening. So I expect deflation. There has to be some deflation, especially in asset prices. And
well, and that's what we've seen so far this year. Is in asset prices, we're seeing deflation. In consumer goods and services, we're seeing inflation. It's like the worst scenario. Your assets are falling and everything you buy is going up in value.
Yeah, your costs are inflating and the stuff you own is deflating. It's like a terrible. So anyway, so I'm not sure if I've explained my view thing, but I don't think inflation's going back to 2%. Right. I think it's either going to be a lot stickier than people think, or I actually think, at least I'm prepared for it to go negative, to have negative inflation, which is deflation, which is the worst thing for a highly leveraged economy. It is the nightmare. And so I think that the Fed should be careful what they wish for. Yeah. And I think they're wishing for inflation to go down. I think they might get deflation, and I think they'll wish they could have inflation back again.
You ever try to catch a balloon that's zipping around the house?
Exactly.
The air is coming out. Yeah. That's what they're doing right now.
Deflation would be catastrophic for a highly leveraged global economy. We're not just talking about America. We're talking about the whole world is caught up in this massive debt bubble, and deflation would be just catastrophic. It would be far worse than the cost of living crisis that we have now.
Yeah, I'd like to make a few comments on that, if I may. Yeah, I think you're absolutely right about deflation at this point with a highly leveraged economy. I can't help making a tangent, though. Just, a lot of people seem to think deflation equals bad. Deflation, of course, is not always bad. And in fact, without the debt bubble, a modest deflation is the best type of economy.
Healthy.
Because prices are going down and the value of currency, the value of money is going up. And that's the ideal situation. But everybody thinks deflation is a bad thing because of the deflation of the 1930s. So we have associate deflation with depression. And of course, in this scenario, with a highly indebted economy, then it would be a terrible outlook. I want to just, as I say, to make a couple of points, if I may. You mentioned inflation volatility, and that's very interesting. You know, if you go back, if you think about the 1960s and 70s, and you look at a graph of inflation, I have it in my mind, but we don't have it on the screen. Yeah, I mean, in the middle of the 1960s, when inflation was like at 4%, there were economists saying, oh, inflation's a problem, inflation's a problem. And of course, it was just ignored at that point. Then we got to the 70s and it started, well, sorry, 3% in the 60s. And then it started to get to 3.5%, 4%, 4.5%, 5%, and everybody started trying to control inflation. But in the 70s, you know, we have two attempts to control inflation where inflation came down significantly and then went up again until, of course, Volcker came in. And Volcker's great insight was, Volcker's, I don't know how, insight's maybe not the right word, but Volcker's insight, if you like, was to say that to control inflation, you had to move interest rates above the rate of inflation. And he recently commented that during the 70s, there were lots of, quote, attempts to control inflation where interest rates did not go above the rate of inflation. You have to go right above it to kill it. And we're obviously a long way from that now. The other thing I would just say, you're absolutely right. You know, you mentioned, you know, people who think inflation is linear, and you refer to other markets. I mean, I think that is one of the great lessons. If I could impart a lesson from my long years of experience, one lesson certainly would be not to expect markets or indeed economies to be linear, because they're not. And again, you know, you think back to the 1970s and gold, you know, gold went from $35 to $850, and we know at 35 it was suppressed. But in the middle of that, we had 100%, sorry, a 50% decline from almost 200 to just over 100. And you look back at 2000 to 2011, where gold went from what, 250 to, you know, 1950. We had a couple of fairly significant pullbacks during that phase. So the one thing I would say to people is, first of all, don't extrapolate short-term trends. But secondly, you know, don't get spooked by, am I allowed to say that word today? Don't get freaked out by pullbacks, because you will get pullbacks in long-term trends or bounces in long-term negative trends.
No question. Tom?
Yeah, the metaphor I think of is a learner driver trying to drive a car with a manual stick shift, and it lurches and stalls and lurches and stalls. And so that's sort of how I see the economy, because that's how the Fed's driving, with these very sort of blunt instruments, you know, just pushing the gas and pushing the brakes. And I think there's lots of evidence that instead of moderating the business cycle, they amplify it, and it gets worse and worse with the more leverage. And so that's, I think, inflation is an effect, and the cause is the bad driving. So that's why I think we had 9% inflation. Next up could be negative inflation, you know, and then after that it could go even higher. So it's just a sort of a rough roadmap that I'm trying to use to navigate the markets without becoming sort of too married or fixed to one particular direction.
Yeah, I agree. And you know, the bottom line is, how do I put this? The Fed, my personal opinion, needs to go away. All right. It's not going to happen. I mean, we've had some very, very key people that have advocated for this, have done all the homework and have pushed this in the public space. It's just not going to happen. The forces against that are just too powerful. But that's really what needs to happen. I mean, Adrian hit it on the head. Deflation is not bad. In fact, deflation, in my personal opinion, is what we should be looking for in a world that becomes more efficient and has new innovations. Prices should come down on things as we learn how to deliver them and produce them better than we did in the past. That should be the end goal. This idea that we have to have 2% inflation to move forward is crazy to me. Let free markets sort it out. But of course, that's just never going to happen.
Well, it's deflation rewards the people who make the good decisions.
Yes.
You know, it gives the right incentives for people to save and work hard. Whereas inflation does exactly what Adrian was saying before. It rewards those who don't have good financial discipline.
Yeah, no question. Go ahead, Adrian.
No, I was just going to say, let me ask if I can change the subject.
Yeah, sure.
Let me ask Tom. I mean, as everybody knows, you know, Jerome Powell, Fed head Jerome Powell, is making his speech at Jackson Hole tomorrow. And of course, none of us here knows what he's going to say or how the markets will react. But Tom, do you have some thoughts on that?
I think I'm just guessing like everyone else, but I think what happened is, you know, a month and a half ago, we got close to the brink. I think, you know, credit spreads were blowing out. Emerging markets were really coming close. I think there was about to be a big problem in the derivatives market. Like it was on the brink. You could sense that we were getting close to some kind of contagion. And then Powell and some of the other, excuse me, the other central bankers, they sort of relented a little bit. They came out a little bit dovish, and the market just soared. And I think, you know, they made that neutral comment, and I've got something stuck in my throat. So, oh gosh, I can hardly talk. So,
the Fed is making us all choke. Don't worry about it.
The Fed completely ran. It sort of appeared to sort of relent on the tightening, and the markets rejoiced, and they've really rallied since then. And as we know, the markets generate the liquidity themselves. Like financial conditions, the tightness or looseness of them are not just determined by the Fed. In fact, they're not really determined by the Fed at all. They're determined by the markets and the market's ability to generate liquidity. And in the last 6 weeks, we've seen a massive loosening of financial conditions. And I don't think that's what Powell had in mind.
Right.
And so now I think he has to come down tough again. I think he has to come out and say, no, we're not stopping anytime soon. We're serious about this. The market has misunderstood what we were saying, and interest rates have to keep going higher, and QT has to proceed as on schedule, and that's so I expect him to be quite hawkish, I guess, is the bottom line. But
right. And how will
do
the
you mind,
market
guys? I
react?
just got to get a drink of water.
Yeah, please.
Sorry. Yeah. Sorry. Yeah, no, I agree absolutely. Powell has to make the markets realize that the Fed means it this time. The markets, of course, are so used to, you know, the Fed saying we're going to tighten and then, you know, backing off at the first hiccup in the market.
They don't believe him.
What?
They don't believe him.
No. And why should they? Because for most people in the market today were not in the market in 1980.
Yeah.
So their whole professional life has been of a Fed that backs down at the first sign of trouble in the stock market. But you mentioned something you said a word that was very interesting. You talked about something breaking. You know, I don't think this Fed cares too much about let's just say the economy slowing, manufacturing slowing. I don't think they care too much about asset prices coming down. But what they definitely will care about is something breaking. And we don't know what that will be. I mean, it could be a derivative blowing up, as you say. It could be one of the major banks needing you know, a bailout. We don't know what it'll be, but I'm not sure. I think the Fed this time is prepared for a lot more pain in the stock market and in asset prices generally.
I completely agree. I think, and this is the first time we've seen this in a long time, where the market, with the Fed is not, it doesn't care if stocks go down 20%. I don't think that's going to phase it. Maybe even if house prices go down 20%. I think the thing that really gets the Fed worried is if the Treasury's ability to fund itself gets called into question. Now we've got a problem. It's in the credit markets. It's the credit markets that are
right.
important.
Absolutely.
It's the corporation's ability to fund themselves, and above all, it's the Treasury's ability to fund itself.
No,
if anything happens with that, that's when the Fed gets involved. But until then, I think they'll actually be happy to see the stock market go down another 30%.
Yeah.
Which is why I think he needs to be hawkish in his speech, because they didn't want, they're not happy to see the market rally whatever 20% in the last 6 weeks. So
well, that rally just demonstrates what we were saying when you were out, that most market participants today, their whole professional life has been of a Fed that backs down. And so the market today is looking for any sign that the Fed is going to back down.
yeah.
And they took it from Powell's press conference, but they took those comments and sort of ignored everything else and exaggerated those comments.
Yeah. It's interest rate chicken is what's going on right now. We're going to see who blinks first. So.
You know, there is another dimension to this. I cynically don't think the Fed is that independent.
I agree. I 100% agree. They're completely political.
You know, there's a political dimension. When you think back to Volcker, for all of his failings as a president, Jimmy Carter had the courage to nominate Paul Volcker, knowing what Paul Volcker intended to do. And Ronald Reagan in 1980 had the good sense and courage, and it was the beginning of his term, to support Volcker. I don't know that Biden is going to really keep pushing Jerome Powell to cut, you know, to raise interest rates if we go into a serious recession, if unemployment starts rising. I think at some point, the political pain of unemployment going up and of people, even though you have no intention of selling your house, everybody knows what other houses on their street are selling for.
Yeah.
The pain of housing prices going down and the pain of opening your 401k statement or your IRA statement every month, I think that's going to become more significant than inflation at some point.
If I could switch up here a little bit, I want to go one more thing that you've espoused as long as I've known you, Tom, and that's this concept of the Dow-Gold Ratio. You know, I'm a firm believer that if you're going to measure anything, you have to have the right instrument to do so if you're going to get a valid measurement, right? So if you're going to measure length, you need a wonderful ruler. If you're going to measure time, you need an incredible timepiece. If you're going to measure value, you don't use dollars, you don't use euro, you don't use yen. So you've done a lot of work in this, and you've analyzed the markets by looking at the thing called the Dow-Gold Ratio. Can you share with our listeners what that is first, and then where do you think we are in that long-term cycle?
Yeah. So all the work I've done, all my experience, everything I've learned over the years, I think we're in a bear market. I think a bear market began certainly at the beginning of this year, but you could even take it back and you could say even the peak of 99 was in a way a very important top, even though in nominal terms the stock market went higher. But anyway, I think we're in a bear market. And so the Dow Gold is how I track the progress of the bear market. And the reason I measure the Dow, it could be the S&P, it could be the Russell, it gives you the same result. But the reason I measure it against gold is for the reason that you say, that it's a constant yardstick. The dollar bounces around for political reasons, because there's a war. We've talked about, a few of the different reasons. So, and another reason is because I'm not convinced that this bear market will be reflected in the nominal values of the stock market, of the Dow or the S&P. Just like in the 70s, the Dow actually was the same level 10 years later, only it had lost 75% of its value in real terms. And I think something like that could easily happen this time. So I want to make sure that I'm capturing the bear market correctly. And the only way to do that is to measure in something that can't be printed or inflated.
Stores purchasing power.
Yeah. Hey, Rich, I think we're at that time. I see questions coming in.
Yes.
And we definitely want to get to listeners' questions. So over to you, Rich.
Yeah, so I'll start firing away. The first one is just a comment. It was right from the start from an anonymous attendee. He said, hi all, hi Tom, miss seeing your family off the road. Obviously he's referring to your missives, postcards from Fringe that were widely followed and I can tell you very, very well received. So
thank you.
Yeah. Just some wonderful comments on that. Let me see.
Thinking about writing them again, about firing them up again.
I will tell you, if you wrote them, I would read them. So John is in, he says, with all the AKA free dollars handed out during COVID fueled inflation, and now those very same people are being punished with the current inflation trend far exceeding any of the COVID assistant benefits. Do you agree? So basically he's saying, listen, they were handing out free money, but now you were talking about the medicine and the medicine causing more damage than the affliction. It looks like that's what's going on right now, because inflation is having a much greater impact on people than the COVID pandemic and the shutdowns ever did. Would you guys agree with that?
Well, it's not really free money, is it?
There's nothing free.
Yeah.
We all pay for it. So. And I'll just go, you mentioned that, Adrian, you had said something earlier when we were talking about the student loan forgiveness. I actually saw a Twitter clip where I think Bill posted it today, or Dan Denning did yesterday, where they talked about, they had this guy basically confronting Elizabeth Warren. And he went up to her and he said, listen, I went ahead and I did the right thing and I paid for college, and I've been working 2 shifts for so many years. My daughter's been working since she could basically walk to pay for her college. Am I going to get the money back that I spent on college as well? And she said, of course not. I mean, immediately, didn't even hesitate. Then he came back with, well, why? He goes, I made all the right decisions. My friend went ahead and bought a car. He took vacations. He borrowed money to the hill, and now he's going to get forgiven. Why wouldn't I? And she's like, well, it doesn't work that way. She starts smiling. He's like, you're laughing at me. She's like, no, I'm not. And then he just kind of storms off. But you were talking about people being angry that did the right thing. I mean, they're coming out already on that note. And John, you're right on track as far as we're concerned. Tony says, agree on the social damage. Those of us that worked hard and missed some things, so we pay our bills. And that's kind of the comment I just shared with you from Elizabeth Warren interview. Agree, Tom. The question would be, how much time between the two, or is that a big variable? So this goes back, this question came up when you're talking about inflation volatility. Yeah. So you're saying it's going to ebb and flow and ebb and flow. Is that, are we talking months? Are we talking years? Do you have any idea?
In my experience, things always play out a little bit slower than I expect. I always kind of imagine these things, and then I sit there day after day watching the markets ready for it to play out just as I thought, and it always takes longer. So and also, as Adrian said too, the pain hasn't ratcheted up yet. So we're definitely still in the stage where the green light politically is to still continue tightening, and so that's got to play out, and then the recession, and then companies have to start laying off workers, and then it has to get to the point where everyone's howling, and even then they may still not react very quickly. So I don't know, I'm sort of prepared for it to be a couple of years, and again, back to the 70s analog too, those waves of inflation, it came in 3 waves. I mean, we're talking over a decade. So, you know, there were multi-year waves.
Right. Rick Rule has a wonderful saying. He said it more than once. Just because something's inevitable doesn't mean it's imminent. Yeah. Which is what you just said. Yeah.
And I'll quote Bill Bonner. I saw him speak at the was at the Vancouver seminar when they still had him out in Vancouver, and Bill Bonner got up, opening speech, keynote, and he said, "Listen, I've been telling you the end of the world is coming for like 40 years now, and it hasn't happened yet." He goes, "Why the hell are you listening to me?" So yeah, maybe not inevitable or imminent, but inevitable. Tony again, he said, "Rich, Adrian, and Tom, thank you for doing this. Tom, tell the family hello and miss them. Agree on no need," in quotes, with the Air Bunnies for their manufactured inflation and manipulation behind it. I think that was a comment about, you know, let free markets work. If I think I got that right. Tony says, "I don't think the Fed will care about breaking the middle class." Anybody think they care?
Well, again, we talked about it. I think their primary response is, their primary directive is to make the Treasury seem solvent. So, yeah, they haven't cared about the middle class for a long time, I think you could argue.
Yeah. Adrian, anything to add there?
And support the money center banks. That's another important thing, because who are the owners of the Fed? Exactly. And 2009 was the most, you know, the most obvious case where, you know, they weren't looking to support the middle class or Main Street. It was a bailout for Wall Street, no question.
Yeah.
The third mandate, right? So you want to keep interest or inflation under control. You want to keep employment at a reasonable level, and you got to take care of the banks and brokerage houses. That's the Fed's tri-mandate, if you will. Tony, what do you guys say? Could all of this be purposely done to break a lot of things? I guess I'm adding words here, to bring in a reason for universal basic income. I think this is all a orchestrated plot to get us to the point where everybody says, yes, give me free stuff. We all need it.
Well, we're already at the point where, you know, over half the population is now on the receiving end. They are net receivers of government largesse, not contributors. And, you know, this is a huge topic. Whether it's deliberate or not, I'm not sure, because I tend to be very, very skeptical, frankly, about, you know, conspiracies and grand schemes of government to do X in order to achieve Y, because I'm just not sure. I won't say that they're that clever, but I'm just not sure that, you know, things always work out the way people intend. But, you know, there's no question that more and more people, I mean, on a larger subject, this is the problem with democracy, isn't it? You know, as Mencken said, an election is an advance auction on stolen property. And the more people, you know, the more, I mean, the US is meant to be a republic. Remember when Ben Franklin was asked, have you given us a democracy? He said no. He didn't say yes and a republic. He said no. but a democracy, and that's why we have the Electoral College. That's why
he's given us a republic if we can keep it, right?
Yeah, but that's why America has these things that people think are quirks, like why Wyoming has 2 senators and so does New York and Florida and the Electoral College and so on and so forth. But I mean, the more people realize that they can get what they want by voting for it instead of by working for it, this is something that builds on itself. And once people have, I mean, we saw this in England, right? Until Thatcher came in. We saw multi-generations who had been on the dole. You would say to, I mean, I remember in the 60s, you'd go to a party and you say, oh, what do you do? And one guy would say, oh, I'm a student. Oh, I'm working at not a software, I'm working at whatever, my dad's grocery store. Oh, I'm on benefits. It was like it was a job, and
benefits, food stamps and benefits are all the modern day soup lines of the 30s.
Yeah, but there are people whose parents, whose father never had a job, never. And now they're following that same path. And the more things are given out, because student forgiveness, let's face it, is just a redistribution.
Well, it's the elections are coming up. It's all political.
Yeah,
there's no question about that.
But this is not forgiving everyone's student debt. This is redistribution.
Yeah.
And the point I was
to the potential voters
was that the more people get things, the more they expect things. I mean, there's nothing like giving someone something for a period of time and then taking it away to feel wrath. People expect things after you've given it to them for a period of time.
So is this all just a big Pavlov's dog experiment? Are we all going to start drooling when they stop giving us money?
I'm not sure it's an experiment. I don't think they think it out that well. But yeah, more and more people will say universal basic income is the solution to this. No question.
Yeah. Well, you mentioned Thatcher. The first thing that came to my mind was socialism is incredible or wonderful or works great until you run out of other people's money. And I think that's the point we're at right now. Charlie, this is for you, Tom. Is there a graph or at least a verbal explanation of your market value in terms of gold looking at the past 20 or 30 years? And I'll just throw out there, as you're in that explanation, I had written down near the close today, the Dow-Gold Ratio was just under 19 at 18.92. Maybe in answering that question, you can also tell us just kind of where we are in that cycle and where are the turning points, because I know you touch on them.
Yeah, well, we can go back a century. There have basically been 3 big cycles. At the peak of 1929, then 1965, then 2000. Those are the three peaks, and then the 3 troughs were 33, 82, and I think the next one's coming up in the next 10 years or so. But yeah, so I think we're about halfway. The 99 2000 peaked at about 44, and I don't know. It could go back down to 1, like it was in the early 80s, or it could go to 5. It doesn't really matter. Either way, it's a long way below where we are now.
Yeah.
I call it the long walk down the mountain. So we'll see. But it really comes down to it just comes down to this idea that the stock market swings in cycles from overvalued to undervalued. It's really such a simple insight, and it has done for a century in really quite clear cycles. And you don't need to overthink it. You buy stocks when they're cheap, and then when they're expensive, you sell them and hold gold and wait until they get cheap again. It's maybe I'm oversimplifying things. Maybe I'm looking at this too simple, but I don't know. I don't want to make it more complicated either.
I don't
I
think
think
we
you're
need to.
absolutely right, but I think the big problem for a lot of people is A, they don't have the patience,
Yeah.
and secondly, they don't have the patience to wait, and they don't have the patience to do nothing. You know, I mean, we're all
including
trying to get that extra little bit. So we bought stocks last month for a rally that was obviously coming. And then we think and hope we're smart enough to sell them close enough to the peak of that rally. And, you know, we're just not prepared to do what you're saying. But frankly, if we did, most of us would be a lot better off.
I know. I'm the worst. I'm so impulsive and change my mind, and so I actually put up physical barriers to prevent me from trading. And I'll just give you a couple examples. One reason I love physical gold so much.
Mittens on so you can't hit the keyboard, or what?
Yeah, well, that's the problem. So I only buy physical gold. I don't buy it on the computer, and then I bury it. And I joke that it's like it's encased in cement and chucked at the bottom of a harbor where there's no way I couldn't sell it even if I wanted to. And the other thing I've done is I've asked my wife to change the password to my brokerage account, and I don't have any access to it. So
Protect you against yourself.
Yeah, like I've like lashed myself to the mast and had the sailors put wax in their ears so that so there's no way I can get out of this, even if I want, even if I have a sort of a moment of impulsive like panic or anything.
Well, you know, it's interesting as a money manager, you know, I'm certainly not saying that I get everything right. I'm not suggesting that for a second. But one of the questions that I get most often over the years from clients is, hey, I gave you $500,000 last month and you still haven't spent it. Should I take it out again? And people want you to do something. You know, that even a client who hands his money to a manager, he wants to see action.
But sometimes inaction is the proper decision and
Yeah,
the right move forward.
It's very difficult. It is actually the hardest thing to do. It's to me the greatest challenge of being an expert speculator is the ability to do nothing. It's so difficult. It's so easy to buy things and it's so easy to sell things, but to do nothing really separates the averages from the experts.
Well, I think a part of that as well is, you know, making sure that you don't let the potential gains blind the number one rule, which is return of investment and minimizing risk. And that's why professionals get paid to do what they do, like Adrian and Tom and whatnot. So risk management is so much more important than chasing returns. And individuals don't always see that.
Yeah, there's a lot more to it than just finding a good stock that's going to go up. Like that's just the beginning of it.
Oh. All right, and just to follow up on that point, Dow-Gold Ratio is simple, and Adrian is right. They are in it for the fast buck, which is why it's so hard just to not do something. JS has a question here. He says, thoughts on the recently proposed Moscow World Standard and its effect on precious metals in the future, and its potential effect against other players like the LBMA and big banks. Any thoughts there?
Shall I go first?
Sure.
Yeah.
If you're ready.
Again, going back to this filter of prism of looking at the markets through a prism of warfare. If I were Putin's advisor, I would advise him that the next weaponizing inflation was a smart thing for him to do. He attacked and at a time when the West had an inflation problem and made it put them in a corner in terms of the potential policy for dealing with that. But the next thing I would tell him to do would be to start vacuuming up the West supply of physical gold to put pressure on the paper gold market, because can you imagine what a political headache it would be if the gold price were rising relentlessly every day. I mean, that would just look so bad. It would just it would really look bad politically for the Biden administration and for the Conservative Party here in England. And so I'm surprised they haven't been moving quicker to do this. But
Well,
yeah, so
do they have access? Maybe that's part of the problem. But I think I just saw something today. Don't quote me on it, but I thought China just bought 80 tons of gold or something like that. Could they be doing it by proxy through their friends?
well, I mean, I think markets are very liquid and they're really quite efficient generally. So all they would have to do is to offer a slightly higher price to buy gold than the prevailing paper gold price in the West, and then the gold would start flowing east, and so they can do that by, you know, through the exchange rate of the ruble and the cost of discounted Russian oil. They could say you can actually get your oil cheaper by paying us in gold at a slightly higher rate than West, and the gold will flow east, and that'd be a very effective weapon in this sort of a broader warfare.
That's the Russian wrecking ball.
Yeah, exactly. Yeah, exactly.
All right. Let me see. I think Tom even mentioned in the past buying it a distance away, so not too easy to get to it. So yeah, the whole concept of making it difficult to sell something, and you really have to think before you take a move with your finances. Charlie basically asked, can you talk about the gold to silver ratio and what effect that might have going forward? And which metal, gold or silver, do you recommend the most? Who wants that first? I have some thoughts there as well.
That sounds like a question for you, doesn't it, Rich?
Okay. Yeah. The bottom line is, different people answer different ways. Some people feel that the gold silver ratio doesn't really tell us anything like it used to. It's not as powerful a tool as it may have been in the past. I don't know. I think the jury's still out on that personally. We pay attention to it. It got as high as 120 within the past couple of years. That was astronomical. Actually, I think within the past year, astronomical price. The rule of thumb used to be when it gets up to 80. And the gold silver ratio, for those that don't know, I think our audience is pretty much knows, but it's the number of ounces of silver it takes to buy 1 ounce of gold. So the concept is that when that number is really high and it takes a lot of ounces of silver to buy an ounce of gold, it usually shows that the market is at the lower valuations of the cycle. So the gold and silver are low and ready now to move higher. Okay. And when it comes down to more traditional levels around 35 to 50 to 1, that signifies the high end or the top of the gold and silver market. And the reason that ratio moves like it does is because gold is always your leader in the marketplace. It will start moving up or down first. Silver will follow and then outpace gold one direction or the other. So, as they're both moving up and silver's moving faster, the ratio comes down. That's kind of the thought behind it. And we've always looked at it as one tool, one indicator as to whether you buy gold or silver. So I don't think it tells you, just looking at the GSR tells you you should buy this or that. It tells you that your insurance premium for your wealth insurance, i.e. buying gold, is cheap right now. It also tells you that there's incredible potential for upside profit potentially in silver. Okay, that's at least the way I look at it. Which you take depends on a lot of other factors as well, not just the GSR, although a lot of people will trade it and they'll sell their gold for silver at these levels. And then when it drops back down, they'll sell their silver for gold. I think gold is probably the best play here personally. I think right now that metal is reacting properly to financial catalysts, financial, I guess, tremors, whatever the case might be. It's doing its job. Even though it's come down, it's only come down 4% this year. Asset markets are down 9, 12, 20%. Bitcoin's down 53, gold's down 4%.
And the dollar is up.
And the dollar is up 14%. Okay, so against that headwind, you know, the anti-dollar gold, it's only down 4%. Gold is deflating slower than other assets. I think it is doing its job in this deflationary cycle where they're letting air out of the balloon, taking the punch out of the party. I think silver's still got some more headwinds. It was hurt because it's also very much an industrial metal, and when the supply chains and economies were locked down, less silver was consumed, and we built up a little bit of a surplus, and we've got to clear that out before I think you see the price go meaningfully up from there. So I think gold is the play right now. Silver is dirt cheap if you've got the money. I can't see it going a hell of a lot lower. I just think you're going to have to wait a little longer for it to go higher, personally. Any other thoughts on that?
I completely agree.
Sorry.
Yeah.
No.
Sorry, Adrian.
No, go ahead, Adrian.
No, I'll just say not only in the last sort of 6 months has silver had more headwinds, but if you look ahead, potentially there are more risks for silver than there are for gold. You know, if China's economy goes into a serious recession, you know, that's going to hurt silver more than it's going to hurt gold. Similarly, if the price of energy, you know, goes up so meaningfully that, you know, we start going back to fossil fuels and even to coal, you know, that might mean a lower demand for solar panels, which will be a lower demand for silver. So the point is there are scenarios, you can rational scenarios that would hurt silver more than would hurt gold going forward.
Yeah, I tend to agree. I think this is gold's time to shine, if you will, and you know that's where I'm looking. John's in with a question. You would think that the strategy on student loan forgiveness should have been to convert all outstanding debt to a no interest loan, thus only requiring payback of the principal loan amount. This would have treated all debtors equally, regardless of annual income. Any thoughts there? I like it. I wish, John, I wish that our leaders thought as deeply as you do.
It would have definitely have been better, no question. It
Yeah.
still wouldn't answer the question of the person who's already worked hard and paid off their debt.
True.
But it certainly would have been a preferable policy.
Yeah, and you know, I look at that and I just look at the bigger picture. I look at what happened in the past couple of weeks. So we signed nearly a $250 billion Inflation Reduction Act that will reduce no inflation whatsoever. As everybody's noted out there, it will all the spending is done up front, and all the credits or what have you, or the benefits are supposed to come later, but we all know they never, ever will. Our politicians have learned nothing from what we're going through right now. They're spending more money than we have, thinking you can spend your way out of debt. It's the most preposterous thing I've ever heard. And then on top of that, we're going ahead and forgiving loans and killing revenue as we're spending more money. Let's face it, if the banks look at debt as loans as revenue generators, right? You've got the repayment of interest or principal, but also you get interest on that. You earn something. We're killing both the interest and the principal. Revenue's getting cut as we're spending more money. I don't know what they're doing other than buying votes, and it doesn't bode well for the country going forward. So. And I'm looking to see if there's any more. Oh, another. Just so you know, we're going to have to let Tom go to bed at some point, and I'm going to want to get some closing argument or closing comments from everybody. Tom, this is truly an international webinar. We've got Adrian coming to you from Puerto Rico, and thank God that storm that was brewing has not kicked you off the air. Wonderful to have you. I'm from the hub of the precious metals universe here in Rockville, Maryland. We've got President Biden right up the road, 2 miles from here at a Democratic National Committee meeting, and we've got Tom in Chiswick, London. So we're all over the place, but it is really late It was late before we started tonight for Tom, but Tony says, between you three, is the feeling still the US government would not confiscate gold as previous? And what would it take for that to happen again? Or are we beyond that confiscation, at least for a while longer? And I absolutely have thoughts here, but go ahead first, gentlemen.
Well, I have some thoughts. Yeah, I don't think it should be top of the list of concerns at the moment. You know, I don't put anything past government, right? Nothing, I don't think anything is past government. But, you know, there's a couple of things. Number one, in 1930, most gold by US people was held in the US in bank vaults. Most. It was a lot easier for a government to get at it if they needed to than it is today, where people own their gold all over the world. Number one. Number two, gold was still a part of a monetary system in 1933. And so there was a monetary policy impetus to revalue gold. That is not the case today. The third thing I'll say, so I think the conditions are completely different, but the third thing I'll say is that generally speaking, you know, major moves like this do not come completely out of the blue. And you see trial balloons raised, you see discussion in Congress, you see white papers by think tanks and, you know, so on. And, you know, there's just no discussion of confiscating gold at the moment. I just don't think it's an issue at the moment.
Tom, any thoughts?
Yeah, I agree with everything Adrian said. Gold's been a pariah of the financial system for 50 years. I mean, I just don't think they care about gold. And then, you know, the second thought is, it's now a global bubble, a global monetary system. In the 1930s, it was much more local, and banning gold for Americans and then revaluing, or, you know, devaluing the dollar.
That's it.
Well, the rest of the world would benefit, and Americans would. It'd be like sort of
What the hell are you doing?
cutting off your nose to spite your face.
Yeah.
And the last thing I would say is that it's not. It could happen, but it's I guess it's more philosophic. I don't let it be the reason that you don't buy gold.
Yeah.
Even for me, owning gold is the right thing to do. And if the government screws me in the end, it was still the right thing to do. And I
probably even more so.
I don't regret it, you know. So and I'm not sure if that's making sense, but the strategy is correct, and if the results don't play out, that sometimes happens, but it doesn't mean you did the wrong thing. So I guess don't let it be the reason that you don't buy gold. So I don't worry about it. I don't let it. It's outside my control.
Yeah. Well,
Rich, before you, sorry,
Yeah,
I have to make a big mea culpa. Thank you, Tom. Of course, Roosevelt didn't revalue gold; he devalued the dollar. Thank you.
that's the point. So I've been pretty vocal on this. Anybody that's worried about confiscation, I think that continues to get propagated here in the U.S. mainly by pure rare coin dealers, right? People that's all they do is they sell rare coins, and their argument is, don't want to buy investor grade bullion gold. You want to pay a higher premium for rarities or collectibles because they weren't confiscated back in the 30s. That's the argument. And, you know, don't even listen to those people. All right. Because here's the bottom line. They're trying to get you to pay more money so they get a higher premium. Now, I'm not against rare coins. They're, when bought for the right reasons, in whatever allocations, they're wonderful. We sell them as well. But confiscation is not the reason to go away from bullion. I think there's some risk because it's happened already, right? So it's 100% chance that they can confiscate gold because they did it in the 30s. But their end game was not your gold. the gold was tied to the dollar. They collected as much gold as they could, and once they had it, they revalued the gold at a higher price, therefore devaluing your dollar. The only reason that worked back then is because the dollar was tied to gold. It's not. 51 years, 1 week and 3 days ago, President Nixon took us off the gold standard. And since he's done that, there is no tie to gold. There's no reason to collect your gold to revalue the dollar. They are not tied in any way. Okay, so put that thought out of your mind. It's not going to happen. In my humble opinion, it will never happen again unless we go back on a gold standard. And I think you know my thoughts on what the chances of that happening. We're far too way down the road for that ever to happen. So agree on the no interest student debt. So Tony corroborates there. Please discuss the issue of cashless crypto versus US dollar, or cashless crypto US dollar. So I guess like a Fed coin, if you will. I think this is pure evil, but you know.
Well, you go. You talk.
Yeah, I'll start it off. I was quoted like a year ago by on Kitco saying that I thought central bank digital currencies were concocted and held by Satan himself, and I still stand there. I still believe that they're pure evil. There's nothing decentralized about a government issued crypto. Okay, all it is a more efficient way to do exactly what they're doing now, which is mismanage the money and have more control over your finances. They would have absolute and complete control over your finances. You would have zero privacy. I hope this never happens. We should all fight this at every turn. I don't know if I'm being clear enough about which side of the argument I'm on here, but I hate it. I hate it. I hate it. Don't do it. Anybody else want to talk?
Just I agree. There's no benefit to it over the current fiat system. Doesn't mean we like the current fiat system, but there's no benefit to it, and a lot of drawbacks, a lot of negatives, primarily on privacy.
Yeah, I mean, we already have a digital dollar, really.
We do.
So like,
they're just trying to more efficiently deliver it. That's all.
Yeah, and it just they by getting rid of cash, they just have more. It just gives them more power over us. Here in Britain, cash is rapidly disappearing. You know, everyone just taps their cards now on these devices and
everywhere.
Yeah.
So I'll add one more theory, personally held, not the company's theory or whatever, but I think what happens is if they do go to a centralized digital currency, a central bank digital currency, a CBDC, that decentralized digital currencies like Bitcoin and others will become far more important to people. They'll become the black market. You know, one thing I've learned in 26 years in this industry is, and just studying it in the past, is anytime traditional markets fail you, black markets will emerge and solve the problem, fill the void. Okay, so I think that's what Bitcoin becomes. And I think in that environment, gold, silver become your new cash.
I'm not sure. I think generally people are very compliant, and I don't see people complaining about the cash disappearing. I think most people think it's quite a good idea, and they'll go along with it without really questioning it.
Yeah.
I mean, don't you get that sort of feeling?
Yeah, I do. I think we're going cashless, but I guess what I was talking about is more if we went to a central bank digital currency. So the idea that is the only way to buy and sell anything. They put the funds directly in your account. They can take funds directly out. If you're not spending it fast enough, they can pull it out from you and withdraw it because they need velocity of money. If they want to impart negative interest rates, they have total control. They know all your buying habits. I mean, that type of environment is what I was talking about. Cashless, I mean, I still think there are going to be holdouts. I mean, I'm one of them. I've never done anything illicit in my life, and I don't intend to ever. But I like having cash. Sometimes I want to buy my wife a gift and I don't want her to know about it. I mean, just little stuff like that. I think there's a use for cash, and I don't see any reason to take it away. Good people use it too, not just criminals.
Yeah, it's convenient. Yeah.
Yeah. So, let me see. Sometimes power goes out. Yeah, and there goes the whole idea that crypto is no longer operational if you can't access it, right? And I do like what your rule is on premium. You mentioned in your letters, Rich. So thank you, Tony. Everything we do is heartfelt. Our job is to help you do the best you can in achieving your goals with what we can help you do it with, which is primarily the precious metals markets. So I think we've run the gamut on the questions, gentlemen. So what I'd like to do, I'd like basically for you just to give us some closing thoughts. We'll start with Tom, we'll go to Adrian, and then I'll just finish up if that's okay. But also, if you can tell people how they can find you. And Tom, there's a special deal Dan suggested for our listeners of this webinar, and I'll get to that as well. So I can tell them about that. But if you could just give us your closing thoughts on what we've talked about tonight, maybe what the most important point is and what people should do to go forward, and then how best to reach you if people want to hear more of what you have to say.
Yeah, thanks, Rich. Well, I'm really grateful that you both, Adrian and Rich, invited me to come on here and chat with you guys. It's been fun, and I don't know. Yeah, I think to me that the point that sticks out that it kept coming back was the idea Adrian introduced about rewarding bad behavior and punishing good behavior. I mean, it's an intellectual idea and not necessarily actionable for us little guys, but yeah, that'll stick with me. And if to read us, we're on Substack. Bonner Private Research .substack.com is our new home for our publishing, and we're having a good time. We're trying something new, a model that doesn't use any advertising or product marketing or anything like that. We just publish and have our readers, and that's it. It's very simple. I don't know the offer that Dan.
Yeah. So basically, just so everybody listening, I've got a link for everybody that's listening here tonight that we're going to provide to you. Okay. So you're going to get that sometime tomorrow. We try to get it out tomorrow morning. Everybody that registered, not those that attended, but everyone that registered is going to get a full copy link to this video. And in that email, when we send it out, there will be a link that you can subscribe to the subscription end of Bonner Private Research. Okay. I highly encourage you to do that. One, because it's worth every single penny. But two, because they're offering an amazing discount. They're basically offering it at the charter price. That's what Dan offered. So it's like a 75% discount from what they're doing right now. If you just follow that link, and it'll be in your email tomorrow. Again, at full price, it's beyond a bargain. Even better with what they're doing for your attendees.
It's $400 a year.
Yeah.
But it's the charter price is $100, which I think is very cheap, and you get Bill's essays and my essays and Dan's essays, and yeah, so it's great.
Absolutely. Again, at $400, it's worth every single penny, and then some. But great deal, and thank you guys for doing that. As Dan said, we're all like-minded, we're all friends, so really appreciate you doing that for our listeners. So, all right, Adrian.
Yeah, I'll just endorse Tom's newsletter as well. I read it every day, and the whole service, as you say, you get Bill's Bill's writings as well, and Dan. So I read that every day. It's well worth it. Let me just say, I don't know, we should have talked about this before, Rich, but if there are questions that were not answered,
yeah,
I would be more than happy to answer those questions if they're applicable to me. So I don't know if
too.
you have a place tomorrow in your email.
Yeah, I'll go ahead and we'll make sure that we add that in before we send it out. I could tell you it's probably just going to be info ASI at assetstrategies.com, but we'll put the link in the email that goes out to you, and we'll pass it around so everybody gets a shot.
Happy to answer those questions.
Yeah.
So my passing comment, I guess, would be, and this sort of goes along with the sort of theme that we've all talked about, but particularly Tom, I think, and these are my words, not Tom's, but you know, we've had a 30-year boom. We've had a 30 years, really. It's not just since 2009, but we've had, you know, since the mid-90s with Greenspan, we had the Fed put. Greenspan should have known better. Remember, the Fed put initiated to bail out the smartest men in the room. They were also pretty wealthy. They could have taken their lumps. But so we had the Fed, and we've had that Fed put for 30 years now, and the market has been, and we've had excess money creation for 30 years, and the markets have gone way above rational valuations. The markets have gone up far more than the economy has grown over that period because of excess money creation and because of the feeling by most market participants who were not market participants in 1980, but have only been market participants during this phase, the feeling that the Fed will bail them out. So you buy every dip regardless of price, regardless of value, regardless of circumstance. And I think the lesson what I would like to leave people with is that things have changed. Now notice, I'm not saying this time is different, the four most dangerous words in the investment lexicon, but things have changed and we're going to go away from that phase. And let's not forget, you know, right now, well, even at the recent low for the S&P, after the S&P had dropped 20 whatever percent, the S&P was still trading over 19 times earnings, which is not cheap. I don't know what it is today because I haven't looked, to be honest. But the point to make is that markets are not undervalued at this point. Valuation is very important. It doesn't tell you, valuation doesn't tell you when a market's about to collapse or about to rally, you know, overvalued, undervalued. But what valuation tells you, in this case, overvaluation, tells you how much risk is in the market. Doesn't mean the market can't continue to go up, but it tells you that there's still an awful lot of risk in the market. And that's what I would leave people with. My email, you know, we manage money for clients in both global and resource stocks. And the website is www.adriandayassetmanagement.com.
Absolutely worth checking out for anybody who has an interest in global and resource stocks. I can tell you, I've known the man a long time. See for yourself is all I can say. I don't think I'm allowed to say anything more about the SEC knocking on the door. One point you mentioned that it's not different this time. It's changed or something like that. We had a saying when I was in the Army, because the situation was constantly in flux, typically in the military. And we had a saying that I didn't lie, the truth changed, right? So the one final thought I want to leave you with is something I mentioned earlier. I just think everybody needs to really pay attention to what's going on and you know, focus on the important things. There are times in our lifetimes, in our history, where I think I read this from somebody here recently. Holding on to what you have is the best you could have done. I think it was something Tom wrote here recently, maybe Dan Denning, but you know, I think it's one of those times where, you know, you're not chasing wild returns. You have to pay attention to risk probably more than ever. It's not time to make wide sweeping changes in your life, I don't think, right? You don't go out on a flyer and hope it works out in an economy that looks like it's going to be really troublesome for a bit of time. Remember, assets are falling. Our means to buy things are falling. Everything we need is going up in price. This is the time to hunker down, really evaluate your wants versus your needs. And you should be focusing on your needs. Leave the wants for some other day. So that's what I would leave you with. I want everybody to be successful. And I think if you're not buying gold here, that's a mistake. That's something we want to change. I mean, it is dirt cheap, in my opinion. And we haven't hit that turning point for the Dow-Gold ratio. I think you still got plenty of time left in it. To encourage you to do that, this offer will be in the ad tomorrow, as well as how to reach Adrian. We'll put it all in there. But we're trying to encourage you to do it. Normally, we would give away free shipping at $20,000. That's about 10 ounces of gold or 1,000 ounces of silver. We're going to do that for anybody that buys $5,000 worth of material. So if you buy anything, gold, silver, platinum, palladium, $5,000 worth, we're going to give you free shipping, regardless of what it is. And we're going to give you a free silver eagle. We're trying to encourage you to do what we really think everybody should be doing right now, which is get off the fence, take advantage of the strong dollar, because I don't think it will last, and put it into something that will last. I think gold is the way to cryogenically freeze your purchasing power for the future, and you're going to need it. So hopefully that'll help you do so. With that, I just say thank you, Tom, for the commitment and the effort to be here. I know you are ready to go to bed at this point, because I am, and it's only like 8:39 here. And Adrian, thank you so much. Met my full expectations as a new co-host, and look forward to many more webinars with you. And thank you all for joining us and hearing what we have to say. Hopefully it did some good for you.
Thank you.
Good night, all.
Good night. Is that it?